Hello everyone, welcome to EduTap and welcome to the Finance 360-degree session. In today's session, we are going to discuss the three important news articles. The first one is regarding the SEBI that has extended the timeline for implementing framework for the ODIs. So we will understand about this participatory notes about this ODIs and what is the basic framework, as well as we will discuss the extension of the timeline. Okay. Then we will discuss about the SEBI that has eased the norms for the Category II alternative investment funds. So what are the Category II AIFs and how the norms have been eased. So these news articles we have to discuss. And the last one is about the outward remittances under the LRS that has been, the data has been provided. So we will discuss briefly about the LRS, about the Liberalized Remittance Scheme, and we will discuss about the outward remittances. Okay. What is the percentage of the fall that has happened in the outward remittances and why is it so? Okay, so I will provide you the important points that you can remember from the examination point of view. So good morning everyone and welcome to the session. Good to see all of you in the session. So now before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel. You will get the PDF of the session in the Telegram channel, and the link for the Telegram channel is provided in the description box below. Now the three news articles, they are important from the objective part of your examination from the phase 1 and the phase 2 perspective. Okay, so let's start with the discussion. So first of all, we are going to discuss about the first news article. Give me a thumbs up if everything is fine, if I'm clearly audible and visible and there is no problem. Okay. So let's start with the first news article that SEBI has extended. So market regulator SEBI, Securities and Exchange Board of India, has extended the timeline for implementing the framework for the ODIs, for the offshore derivative instruments by FPIs to November 17, 2025. So first of all, what is this ODI? Try to understand that there are certain foreign investors. There are the foreign investors that want to invest in India, that want to invest in the shares, in the debt of India, but they do not want to register with SEBI. They do not want to take the headache of going through all the regulations and rules and such. So there are foreign investors, or there are foreign entities that want to invest in India, but they do not want to register with the SEBI. Okay. So this is the basic idea. So foreign investors, if they want to invest in the securities of our country, they can do so without registration with SEBI through the offshore derivative instruments, So basically what happens that the foreign portfolio investors that are registered with SEBI, they invest in the securities in India. They invest in the shares, they invest in the debt instruments in India, and the foreign portfolio investors in the form of offshore derivative instruments can sell these shares to the foreign investors, not sell, but they can transfer the benefits of these shares to the foreign investors. Okay, so what happens that the foreign portfolio investors that are registered with the Securities and Exchange Board of India, they are buying the shares or they are buying the debt instruments, and once they have bought these shares or debt instruments, the foreign portfolio investors, they can sell the offshore derivative instruments to the foreign investors that want to invest in India, that want to invest in these securities, but they do not want to register with SEBI. So this offshore derivative instrument, this is a kind of instrument that is provided to the foreign investors, and the offshore derivative instruments, its value is determined on the basis of the underlying shares or the underlying debt instrument. Okay. So this is the basic idea. So offshore derivative instruments, they are financial instruments issued by the foreign portfolio investors that are registered with SEBI, and they should be present in India. Like they should have some presence in India. They should be registered with SEBI. They should be following the rules and regulation in India. So these foreign portfolio investors, they can issue the offshore derivative instruments to the overseas investors, to the foreign investors who want to invest in Indian markets, who want to invest in the shares, in the securities, in the debt instruments in the Indian market without registering directly with SEBI. So the foreign portfolio investor invest in the Indian securities, they invest in the shares, in the debt instruments of our country, and then issues the offshore derivative instruments to their client overseas. Okay, allowing them to benefit from the exposure. So basically foreign portfolio investors, let's say some overseas investors, some foreign investor want to invest in the shares of Reliance Industry. Now the overseas investor do not want to register with SEBI and do not want to take the headache. So foreign portfolio investor will buy the shares of Reliance Industry, and these shares will be bought by the foreign portfolio investor. These are the shares of this FPI. Now the FPI will release the offshore derivative instrument and will transfer the benefits to the offshore investor. Okay, so the through the offshore derivative instrument, that's why the derivative is in the name. Derivative means that the value is derived from some underlying unit. Okay, so the offshore derivative instrument, it derives its value from the underlying unit. That can be share, that can be debt instrument, anything. Okay, so the ownership is with the FPI. Remember that the ownership will remain with the foreign portfolio investor registered with the SEBI, but the benefits will go, or the if loss is happening, that will go to the overseas investor. Okay, so it allows them to benefit. It allows the overseas investor to benefit from the exposure without holding the securities directly. So they are not holding the securities directly, they are holding the offshore derivative instrument that has the underlying unit, that is the shares owned by the FPI. Now why the FPI will want to sell the ODIs? Because with the ODIs, the FPI also gets some fees, they also get some benefit. Any confusion in the ODIs? First of all, so FPIs registered with SEBI, they are buying the shares, they are buying the debt instrument, and they have the ownership. Like I have the ownership of the shares or the debt instrument, but I can sell the overseas derivative or the offshore derivative instruments. I can sell to the overseas investors. Okay, now these derivative instruments, they transfer the benefit or the exposure to the overseas investors. That's it. Okay, now coming to the next part. So markets regulator SEBI has extended the timeline. So there was the framework that was introduced. So there was framework that was introduced or there was tightening of guidelines that was done for the offshore derivative instruments. Okay, so in December 2024, there were the guidelines that were released that tightened the release of the offshore derivative instruments, and there were certain guidelines that were released that we have to understand. Okay, and it was said that these tightened guidelines will be followed from May 2025, but now the timeline has been extended till November 2025. So this is the news article that in December 2024 the guidelines were released that from May 2025 there will be tightened regulations that will be followed for the offshore derivative instrument, but now the tightened guidelines will be followed from November 2025. So basically, conditions for issuing the ODIs. Which FPIs can issue the ODIs? So those FPIs can issue the ODIs that create their separate unit for issuing the ODIs. So that means a foreign portfolio investor shall issue the offshore derivative instruments only through a separate dedicated FPI registration with no proprietary investment. That means if the FPI wants to issue the ODIs to the offshore investors, so FPI cannot do it through its original entity. Okay, the FPI has to have the separate registration, to issue the ODIs, and in the name of the FPI that is issuing the ODIs, in the name of the FPI there should be mention of the ODI. So there is a suffix that has to be used in the name of the FPI. Let's say it is the XYZ FPI that is issuing the ODIs. So in the XYZ FPI, it should have the suffix ODI also, so that it is recognizable that this FPI provides the ODIs, the offshore derivative instrument. Now let's say the FPI, it is buying the shares. Now the FPI, it wants to buy the Reliance Industry shares. It wants to buy 1,000 shares for itself. So the shares that it is buying for itself will be contained in the original FPI, while the unit that it has, the FPI XYZ FPI ODI, this registration that it has taken separately, through this it can create the ODIs. So through the original FPI, through the original unit or through the original institution, it cannot create the ODIs. When it has taken the separate registration, then only it can issue the ODIs, and this separate registration it has taken through this entity, it cannot, or through this part, it cannot have the shares for itself. It can only buy the shares, or it can only buy the debt instruments that it want to create the ODIs for. So this is the basic idea. Try to read this and you will get the better clarity that the foreign portfolio investor shall issue the ODIs only through a separate dedicated FPI registration with no proprietary investment. That means through this separate registration that it has taken for the ODI issuance, it cannot invest for its own purpose. Okay, so proprietary investment, self for the self profit or for self, the investment cannot happen through the separate registration that is done for the issuance of ODIs. Okay, such FPI registration shall be in the name of the FPI with ODI as suffix. So basically, in the name of the FPI, the ODI, this term has to be kept as suffix. It has to be kept. Like in the small finance banks, it is compulsory that they have to keep finance banks in their small finance bank in their name. So like the Utkarsh small finance bank is there, ABC small finance bank is, let's say, example. So in the name of the small finance banks, or in the entities have to keep the name so that they have the small finance banks in their name itself. Similarly, the FPIs that are issuing the ODIs, they have in the name itself, they have to keep the term ODI. Okay, so it is easily recognizable. So this is the basic idea. So for issuing the ODIs, they have to create the separate units, they have to take separate registration, and through that unit they cannot do the self investments. Okay, next is where such addition is being requested for an existing FPI, this addition. So let's say there is an existing FPI, now it do not want to invest for itself, but it only invest to issue the ODIs. Okay, so in this case, the existing FPI addition has to be done, suffix. So where such addition is being requested for an existing FPI, this addition of suffix will not be considered a change in name of the FPI. Okay, directly the suffix will be added. It will not be considered as changing the name. Now, designated depositories participants. So depositories, how many depositories do we have in India? We have two depositories, NSDL and CDSL. They are the depositories that keep our shares in the demat form. Okay, so depositories are the one in the country that keep our shares, that keep our debt instruments in the demat form. So designated depository participants, they are the intermediaries that connect the depositories with the investors. Okay, so depositories that keep the shares, that keep the instruments in the form of demat, in demat form, so they are connected with the investors through the depository participants. So the designated depository participants, they may process the request in such cases and issue a new FPI registration certificate for the FPIs that want to issue the ODIs. So it is the designated depositories participants that can process the request. Okay, this is the idea. Now the second point is, so first point is take the separate registration, and in your name you should have ODI as the suffix. Now the second one is, a foreign portfolio investor shall not issue ODIs. Very important point. So foreign portfolio investor shall not issue ODIs with derivatives as reference or underlying. That means, try to understand that let's say the foreign portfolio investor is investing in the shares, and the foreign portfolio investor with the suffix as ODI, so is issuing the ODI. It is issuing the ODI for the overseas investors. So overseas investors, they are getting the exposure to this share, they are getting. So this share is the reference, or this share is the underlying. This share is the underlying for the offshore derivative instrument. Now it is clearly said that the FPI, they cannot issue such ODIs that have the derivatives like the futures, options as the reference or underlying. So in the reference or underlying, there can be shares, there can be debt instruments that can be kept as reference or underlying of the ODI, but the derivatives, the future option, they cannot be kept as the reference or underlying. Okay, so FPI, they can issue the offshore derivative instruments with the reference or with the underlying instrument, that is the shares or that is the debt instrument. But the FPI that is issuing the ODIs, for the ODIs, the derivatives cannot be the reference or underlying. The derivatives, the futures options cannot be the reference or underlying. Okay, so this is the idea that foreign portfolio investors shall not issue the ODIs with derivatives as the reference or underlying of the ODI. Similarly, another point is that let's say a foreign portfolio investor shall not hedge their ODIs with derivatives. So basically, let's say I'm saying that the foreign portfolio investor is issuing the ODI, is issuing the offshore derivative instrument, and in this case, the offshore derivative instrument, it is sold to the overseas investor. Now, this ODI has the reference or underlying of 1000 Reliance shares. Okay, so the overseas investor has bought this ODI because they want to have the exposure to the 1,000 Reliance shares. Now try to understand that if the FPI do not own the 1,000 Reliance shares, they are just the FPI, they do not own the 1,000 Reliance shares. They have taken a derivative that after 2 months they will buy they have taken the futures. Let's say they have taken the future instrument that after 2 months they are going to buy the 1,000 Reliance share. So that is cheating in a way, or that is wrong. They are kind of like buying the derivative for the reference indirectly. Okay, so through the ODI, if the overseas investors, they are buying or they are having the they are having the exposure to the 1,000 Reliance shares, so the FPI must have the 1,000 Reliance shares. It's not like that it can have the derivative that after 2 months they will buy the 1,000 Reliance shares. That is not correct. So basically, foreign portfolio investors, they shall not hedge their ODIs with derivative position. So basically here you can see the example that the FPI must hold exactly the same security, exactly the same shares or the debt instruments that the ODI is based on, reference on, underlying, based on. So ODI is based on the value of some underlying. Okay, ODI is based on the value of some shares. ODI does not have its own value. ODI is based on the value of the shares. ODI is based on the value of the debt instrument. Okay, so this is the based on, means this is the reference we are talking about. So FPI must hold exactly the same security that the ODI is based on in equal quantity for the entire lifetime of the ODI till the ODI is kept. Imagine you are an FPI and a client in London wants to invest 1,000 shares of Infosys. So the client in London want to invest in the 1,000 shares of Infosys. Now you are releasing the ODI, okay, but doesn't want to register with SEBI. So this client in London, this is the overseas investors that want to invest in the 1,000 shares of Infosys. So the overseas investor is buying the ODI from the foreign portfolio investor. Now this ODI has the underlying of the 1,000 Infosys, or the reference is of 1,000 in shares of Infosys, or the ODI is based on the 1,000 shares of Infosys. Now you offer them an ODI. So you are an FPI, you offer an ODI to the investor linked to 1,000 Infosys shares or reference to the 1,000 Infosys shares. But let's say you do not have the 1,000 Infosys shares, you only have a futures, or you have the option of the 1,000 Infosys shares. So that is wrong. That cannot be done. Okay, you must buy 1,000 actual Infosys shares in the actual time, in the real time, and you should have these 1,000 Infosys shares in your account, in the demat account. Then only you can issue the ODI. So basically, when you actually, the FPI ODI, when they actually own the shares or when they actually own the debt instrument, then only they can issue the ODI that is referenced to the share or debt instrument to the overseas investor. It's not like that FPI ODI is saying that I will buy it after 2 months, I will buy it after 3 months, I will buy it after 6 months. That cannot be done. Got it? I hope this is clear, that you must buy the 1,000 actual Infosys shares in your own account to hedge that ODI, to provide for that ODI. You cannot provide for the ODI by buying the futures or options. So basically the 2 points are saying that foreign portfolio investment shall not issue the ODIs with derivatives as the reference or underlying, as well as the foreign portfolio investor cannot have the derivatives that are provided. Like if the overseas investor want to have the shares, so FPI need to buy the shares. It's not like that you are buying the future so that in the later on period you can get the shares. That cannot happen. Okay, next is granular details of all entities. So basic details and like all the details have to be provided for all the entities that are holding any ownership, economic interest or exercising control. This shall be collected by the ODI issuing FPI from its ODI subscribers. So basically the ODI issuing FPI, so FPI ODI that is issuing the ODI needs to collect all the information about the overseas investor, if the overseas investor has these criterias met. So overseas investor or the ODI subscriber, that is the overseas investor, having more than 50% of its equity investment, share investment to securities of a single Indian corporate group. That means ODI subscriber or the overseas investor that is holding more than 50% of their equity investment in a single Indian corporate group. So that means out of all the investment that they have done, they are holding more than 50%. So out of the ODI subscriber, that is the overseas investor, now out of 100% of the investment that they have done in the shares, out of 100% of the investment that they have done in the equity, if they hold more than 50%, if they hold more than 50%, if they hold more than 50% of the equity investment in only a single corporate group, Indian corporate group. So in this case, the granular details or all the details have to be provided about the overseas investor to the depositories. Okay, so all the information has to be provided to the depositories by the FPI about the overseas investor. So this is the idea. So granular details or all the details have to be provided about the overseas investor by the FPI to the depositories in case when the ODI subscriber have more than 50% of its equity investment only in a single Indian corporate group, or the ODI subscriber and the ODI subscriber having equity position worth more than 25,000 crore in the Indian markets. That means they have the total investment, investment that they have done in the shares of more than 25,000 crores. In these cases, when these two cases are being met, in this case, all the information about the overseas investor has to be provided by the FPI to the depositories, because you can see that they are investing huge amounts, they are investing very huge amounts, as well as they are only investing majority of their investment they are doing in a single corporate. So there might be something fishy that is going on. That's why all the information has to be provided by the FPI to the depository in regards to the overseas investor. Okay, so this is the idea. Any confusion here? Clear? So this is the first news article about the SEBI. I hope this is very much clear. Now getting to the second one. So the SEBI has relaxed the norms for the Category II alternative investment funds. So first of all, let's understand about the Category II alternative investment funds. So alternative investment funds, like the mutual funds, they pool in the money to invest in the different instruments. Similarly, the alternative investment fund means any fund established or incorporated in India which is privately pooled investment vehicle. They privately pool the money for the investment. Okay. So it is a privately pooled investment vehicle which collect fund from sophisticated investors, from the big investors, from the high net worth individuals, from the entities, big entities, whether Indian or foreign. So they collect the funds from the sophisticated investors and then they invest the fund in the different areas. So Category 1 alternative investment fund, they are the venture capital funds, angel funds that invest in startups, small and medium funds that invest in the small and medium enterprises, social venture funds that invest in social enterprises, the infrastructure funds that invest in the infrastructure companies and such. Okay, now Category II AIF, this is what we have to focus on. Category II AIF consists of the private equity funds, debt funds and fund of funds. So private equity fund, they invest in unlisted private companies. Like there are various MSMEs, there are various like medium enterprises and certain like big enterprises also that might not have listed themselves in the stock exchange for now. Till now the LIC also, though it was a government company, but it was also not listed in the stock exchanges till last year. Okay, so you can understand that there are certain companies that are not listed, there are certain medium enterprises, there are certain companies that are not listed in the stock exchanges. So through the private equity funds, the Category II AIF, they invest in the unlisted private companies. Because it is difficult for unlisted companies to gather the funds, because the listed companies that are listed in the stock exchanges, so the listed companies that are listed in the stock exchanges, they can gather the funds by selling their shares, they can gather the funds by issuing their debt instruments. But for the unlisted private companies, it is difficult to gather the funds, and that's why the private equity funds, they invest in the unlisted private companies. Debt funds, so in Category 2, the category 2 alternative investment fund, that is a debt fund, they primarily invest in the debt securities of the unlisted companies, or we can say they invest in the unlisted debt securities. They invest in unlisted debt security that is not listed on the stock exchanges. So unlisted debt securities are the privately placed debt securities through which the private companies, they are trying to gather the funds. Got it? So private equity funds or the debt funds that are under the category 2 AIF, they provide the funds to the unlisted private companies by buying the shares of the, or by buying the equity of the unlisted private companies, or by like investing in the debt securities of the unlisted companies. That is, the debt funds are investing in the unlisted debt securities. As well as fund of funds, that means category 2 AIFs, the category 2 AIFs, they also invest in other alternative investment funds. So the category 2 AIFs, they invest in other alternative investment fund also. Okay, so category 3 AIF, they are usually the hedge funds or the big funds that are involved in complex instruments. So category 2 AIF, I hope it is clear to you. They invest in unlisted companies, they invest in the unlisted debt securities that are privately placed, or they invest in the shares of unlisted private companies. Okay, now coming to the idea that relaxing the norms. So the SEBI has relaxed the norms for alternative investment funds for the category 2 alternative investment fund. So category 2 alternative investment fund shall invest primarily in unlisted securities. So this is the main focus that they have to give, that the category 2 AIF, they have to invest in the unlisted securities, unlisted equities instruments, or unlisted debt instruments. Okay, now they are also allowed. So now they are also allowed to invest in listed debt securities if these listed debt securities are rated A or below. That means, see, category 2 alternative investment fund, they usually have the higher risk appetite because they want to get higher returns. They also have more risk appetite. Okay, that's why they are investing in the unlisted debt instruments. They are investing in the unlisted private companies because they have the risk appetite. They are ready to take the risk to get the higher returns also, because what if this small company becomes a big company and we will get a lot of profit from that. Okay, or the category 2 alternative investment fund will get a lot of profit from that. So the category 2 alternative investment fund, they have higher risk appetite. They can take more risk to get the more returns. So it is said that so before it was said that the alternative investment fund, they primarily have to focus on unlisted securities. But now it is said that they can also invest in listed securities in the stock exchanges, but that listed securities that have the rating of A or below by a credit rating agency, because category 2 alternative investment fund, they have the risk taking capacity. So they can invest in such debt instruments also to get the higher returns, because the more the risk, the more the returns also. Okay, as well as this is the idea that the AIFs, category 2 AIFs, they can invest in listed debt securities which are rated A or below by a credit rating agency registered with the board directly or through the investment in units of other alternative investment fund. So as you have seen before also, that category 2 AIF, they can invest in other alternative investment fund. So here it is written that the category 2 AIFs, they can invest in other alternative investment fund to get the access to the different debt security, or to get the access of the different securities. So this is the basic idea. I hope this is very much clear, that the horizon has been broadened, the investment portfolio has been broadened, and there are more investment opportunities that are provided to the category 2 alternative investment fund. That is the idea. By allowing the investment in the lower credit paper, the regulatory framework will provide AIFs greater flexibility and diversification opportunities. So they will have greater flexibility that where they want to invest. Okay, they can invest there. So more investment opportunities have been provided to them. So this is the basic idea. Clear? This was the main thing that you have to focus on, that category 2 AIFs shall invest primarily in unlisted securities, and now they have the opportunity to invest in the listed securities that have the credit rating of A or below, and they can do it directly, or they can do it through the other alternative investment fund by investing in the other alternative investment funds. Okay, now coming to the last news article. Sorry, I have my Mouth is like it is, I have tonsils and my mouth is also swollen, so it is harder for me to bring out words. Which AIFs can invest in companies having credit rating higher than A? Category 1, Category 3, hedge funds also, okay? So they can invest, and not only AIFs, the mutual funds can also invest, okay? There are like different funds that can invest in the good companies, because if the credit rating is A, if basically you can understand, if you have a credit rating of A or above, your debt instrument, so there is a company whose debt instrument has the credit rating of above than A, so that means that is a good company, okay, that has more possibility of returning the debt. So even the retail investors will want to invest in these companies, even the mutual funds will want to invest in these companies, even the like different funds that are available in the country, they will want to invest in these companies. Asset management, like asset management companies that manage the asset of the high net worth individuals or the companies, they also want to invest in these companies simply, okay. Now next is India's outward remittances. So basically we are getting the remittances, we are receiving the funds, as well as we are sending the funds outside also, okay. Why do you send fund outside? Can anyone tell me? You send the fund for your children that are living abroad, or for your sibling that is living abroad, let's say, okay, you are sending dollars, or you are sending euro, or you are sending the foreign currency, okay. You like take the fund outside for your travel that you want to do. You are going to Japan, you are bringing dollars to Japan. You are going to US, you are bringing dollars to US. So if you want to travel outside, you have to take the foreign currency with yourself. Other than this, let's say you want to invest in the other countries, you want to buy property in the other countries, so you are taking your funds outside, okay, you are sending the funds outside. So for various purposes you send the fund outside, or you take the fund outside. So if just tell me the scheme under which the resident individuals of our country, they are allowed to remit the fund outside. Which, for education also very good, for education, for studies abroad, you take the funds outside. For medical expenses, sometimes you have to do a operation, like you have to do a operation in the other country, so for that also the funds are taken outside, okay. So which scheme of the Reserve Bank of India is available through which the resident individuals, they can remit, or they can send the funds outside for their current and capital account transactions? So it is liberalized remittance scheme. So under the liberalized remittance scheme, the resident individuals, they are allowed to remit the funds to other countries for their current account, and for their capital account purposes. Current account means for trade in goods, for trade in services, for your import of goods, for your import of services, or for the services that you want to take from outside, or for your transfer payments, for the money that you want to send outside for your children, for your siblings. Capital account for your investment, you can send for your investment in the other countries, you can send the money outside, okay. So for your travel, for your investment in the other countries, for your studies abroad, or for your medical expenses, you can take the money outside. That is under the liberalized remittance scheme. So under the liberalized remittance scheme, the authorized dealers, they can freely allow the remittances, the money can be sent outside by the resident individuals up to the limit of 2,50,000 per financial year. That means in one financial year, freely you can take $2,50,000 to the other countries, okay, for your travel expenses, for your study expenses, for your medical expenses, for your different expenses that you want to do outside, okay, for any permitted capital or current account transaction. The scheme is not available to corporates, it is not available to partnership firms, Hindu undivided family, and the trust, etc. The liberalized remittance scheme, it was introduced in February 2004, and since then under the liberalized remittance scheme, there was the limit that was increased for the freely remitting the fund outside. So you can understand that when the scheme was initially introduced, only 25,000 US dollars could be remitted to other countries, or could be taken outside for your expenses, okay. Now in 2015, the limit was increased to 2,50,000. That means this is the limit till which you can do the free remittance. You can send the money easily to other countries, or you can spend the money easily in the other countries till this limit without any requirement of any permission and such. Okay, so under the liberalized remittance scheme, authorized dealers, they can freely allow the remittance, by resident individuals up to the limit of US dollars 2,50,000 in one financial year. Okay, now India's outward remittances, now we are allowed to do the remittance of $2,50,000. So each one of you, Manish, Nitya, Aditya, Shivam, Guru Raja, Mukund, Manish, Amartya, Shivam, all of you, Padmini, and so all of you are allowed to remit 2,50,000 in a financial year. This much, 2,50,000 of dollars in the other countries. Okay, so India's outward remittances under the liberalized remittance scheme by the resident individuals moderated by 6, that means it fell by 6.85%. Before, in the 2023-24, in this financial year, the remittance or the outward remittance that had happened was $31.73 billion. But in 2024-25, in the 2024-25, that means in the financial year of 25, the remittance that was done, the outward remittance that was done was 29.56 billion. So you can see that the remittance has decreased from 2023-24 to 2024-25. So outward remittance has decreased from our country. Now why it has decreased? Because of the global uncertainty that is going on, because of the trade war, because of the tariff war, as well as the Donald Trump stated that now they are not going to allow the Indians to come study, and or they are going to like make stricter norms for the visa. So that there is a lot of global uncertainty that is going on. There is also the muted domestic income growth, because in the annual report we have seen that in the 2024, in the financial year 25, that means in the 2024-25, we have seen the growth rate of 6.5%. That was lower than the 9.2% of the growth that we have seen in the financial year 2023-24. So the growth rate has decreased from 9.2% in the 2023-24 to 6.5% in 2024-25. So if the growth rate is decreasing, that means the income, the growth in the income, that is also decreasing. So with the decrease, correct. So if the growth rate or the income rate is decreasing, we have the muted, we have like growth rate happened or the growth happened, but it only happened by 6.5% in the financial year 2024-25. That's why we can see it affected the outward remittances also. A high base effect. High base effect means that whenever the base is high, so you can see that the remittances were all-time high in the financial year 2023-24. In the financial year 2023-24, we had the all-time high of the remittances, outward remittances. So because the base, if you are starting from 90%, it is very hard to reach to 100%. But when you are starting from 20%, it is easy to reach to 50% or 60% with the basic efforts. So you can understand that when the base is very high, so it is very hard to grow on that. Okay, so the base was very high. That's why it is seemingly like $29.56 billion of remittance is fine. It is fine. But because the base was so high, that's why we are saying that the remittance has fallen, outward remittance has fallen, okay, because of the high base effect. So this is clear, I hope. Any confusion, anyone? So in financial year 2024-25, in the financial year 2024-25, the growth rate of our country was 6.5%. That was lower than the 9.2% in the previous financial year. Because of the lower growth rate, there was lower income growth. That's why we can say that remittance, outward remittances also decreased. Okay. So this is one of the reasons. Now in financial year 2025, the international travel, that is the largest LRS segment. That means most of the people, they take the dollars outside or they take the money outside. For the resident individuals, we are taking the money outside for the international travel. Okay, so the largest LRS segment, accounting for nearly 60%, is international travel. Now this decreased marginally by 0.25% year on year. That means there was a slight decrease that came in the international travel. That's why the liberalized remittance or the outward remittances decreased. Okay. So this is the idea, that the outward remittances decreased because the international travel was lower, as well as there was like the outward remittances were also lower for maintenance of close relatives. It was lower by 19.28%, and for the overseas education, the remittances were lower by 16.09%. The percentages you don't have to remember, just remember that for the international travel, the remittances decreased, outward remittances decreased slightly, but for the maintenance of close relatives, for the overseas education, the remittances, the outward remittances decreased by a lot, okay, because of the visa restrictions, because of the stricter norms for the visa, because of the rising rejection rates in the colleges of America and such nations, and a shift towards more affordable education destinations such as Australia and New Zealand. So usually the US is very expensive for studies, but it is considered that Australia and New Zealand are somewhat in the reasonable range. So what is happening that because of the visa restrictions in US, now the people are shifting, or the students are shifting towards the Australia, New Zealand and Japan and these nations, okay. So for the funds transferred or the outward remittances decrease for the maintenance of close relatives for the overseas education, okay. As well as additionally, the Indian rupee depreciated by 2.4% in financial year 2024-25. So this percentage you can remember that the Indian currency has depreciated by 2.4%. Indian currency is depreciating. That means Indian currency is becoming weaker. That means before for $1 we used to get, let's say, 80 rupees, or we used to give 80 rupees to get $1. Now we have to give, let's say, 90 rupees to get $1. So the rupee has weakened, we have to give more rupees to get $1. That's why also the remittances have decreased. We are sending less dollars outside because it is very expensive to buy the dollars basically. So when the price of dollars, because the price of dollars is higher, it is more expensive to buy dollars. That's why we are not buying dollars to give it to outside, okay. So additionally, the Indian rupee depreciated by 2.4%. Indian rupee has become weaker, which impacted the funds that are sent for maintenance of close relatives outside. Remittances under the gift component has also fallen. So we are not sending the money for gifts also. However, LRS remittances in equity and debt investment has increased. That means because of the volatility that is happening at the global level, Indian investors or the resident individuals, they are investing more in the debt instruments and the equity instruments of the foreign countries, of US and such. So there is more outward remittance, LRS remittance that is happening in the equity and debt instruments in abroad. It increased by 12.45%, and there is more purchase of immovable property abroad. So there is more investment that is happening in property in the other countries. This increased by 33.11% year on year, that is from the previous year. You can understand that for the maintenance of close relatives, the outward remittances decrease. For studies abroad, outward remittances decrease. For international travel also slightly the outward remittances decreased. For the gift also outward remittances decreased, but for the equity and debt investment, outward remittances increased, and for the purchase of immovable property, the outward remittances increased, okay. If we see for particularly the month of March 2025, the outward remittances grew by 10.65%. So in the March month, because there was a lot of international travel that was happening in the March month, so the international travel increased by 12.3% in the March month. In the March 2025, the international travel increased by 12.3%, due to which the outward remittances increased by 10.65% in the March month, okay. So this is the idea. That's it. The 3 news articles we have discussed. Now, the Perspective 360-degree series is going on for your answer writing practice. If you want to practice writing the answers, if you want to know that which topics are the hot topics that you must know about, so all those topics are discussed in Perspective 360, and you are given the material to write the answers. You are given the points that how you can write the answers, what data points you can include in the answer. So this is a very important series that is for your descriptive answer writing, that is brought on Monday, Wednesday and Friday, and at 5 p.m. So Monday, Wednesday, Jaskaran sir is going to take the session, and on Friday I will take the session of the Perspective 360-degree series, okay. Now this is the first question. I hope you will be easily able to answer this question. Try to answer this question. Let's see how many of you are able to answer, okay. Now this is the second question. Try to answer this question also. It is regarding your Category II Alternative Investment Fund. So you have to tell about the investment. Now this is the third and the last question, just basic question, that what is the decrease that you have seen in the outward remittances under the LRS. Okay. So this is it for today. Thank you so much for joining the session. So for Finance 360-degree session, it is conducted at 10 a.m. on Tuesday, Thursday and Saturday. Okay, Tuesday, Thursday and Saturday at 10 a.m. Thank you everyone. Thank you for joining. Sorry, I was I am having tonsils, so I am not able to speak clearly, or I am not able to speak much. But the session was already scheduled, so I didn't want to cancel it. So I'm taking the session, but I hope that you were able to understand. If there is any confusion, you can